All right. Hello, everyone. Bran Bunnag here with Willowmar Real Estate, and I am super excited to be joined by Stephen Barber. Stephen is not only a good friend, but our go-to loan officer at Guaranteed Rate, which is a really well-known mortgage company here in the Bay Area. Stephen is our loan guru and an overall incredible resource when it comes to the most conventional loan scenarios, but also the most nuanced. So I'm happy to have you answer all of my many questions today. So first, let's talk about credit score and history. Is there a minimum credit score to qualify?
Minimum is like 620 or so in the conforming in FHA space versus it's kind of do or die in the jumbo market that you kind of have to have a 700. Otherwise, you may find financing, but it's going to be pretty ugly for them as well.
Okay.
Also, part of the risk pricing is how much their down payment is. So with a 680 minimum FICO score plus a decent down payment, you're typically going to optimize your interest rate pricing. And on the jumbo space, kind of if you're over 720 FICO and you have 20% down or more, don't have to have 20% down or more, that will probably optimize your pricing for you as well.
A lot of people have this misconception that receiving multiple pre-approvals would hurt their credit score. Can you speak more on what exactly is the impact, if any, and are there any advantages to running the pre-approval closer together or bulking them all into one?
Absolutely. And it seems to be a very sensitive subject. People are always very cautious in wanting to have their credit report run. And I understand, but it's kind of a fallacy. The Fair Isaac system has figured it out. And what they have done is that if you have multiple inquiries within the same 30-day period, it's considered one inquiry. And the inquiry is, if you already have excellent credit and your FICO is 780, your score may go down 1 or 2 points or whatever. And it's very temporary, and it should not be of a concern whatsoever.
Something that I learned that I thought was interesting very recently from you is what people should do in the case that they do see that they did miss a payment, years ago or a year ago. What is their best next step in that situation?
You want a letter in writing saying that this is an erroneous account, it should have never happened, and that it should be removed entirely from your credit report. Not just show paid, that doesn't help at all, but removed entirely. Then take that letter and work with either me, and I can get it removed like within a week, or you can just do it organically by mailing it into TransUnion, Equifax, and Experian, and it will be removed completely because they did a letter to say it should be removed, and your scores will jump right back up.
Wow. So I just want to repeat that because I think that's so important. My first reaction, if I saw that, would be to pay it off before anyone notices.
Right.
So I think that's so important to know that having paid it does not help. Really, it's that if possible, you'd like to get it removed from the report, from the history entirely.
Absolutely. And what people don't realize, and what I have to explain to them, is credit, the Fair Isaac system, the algorithm for scoring is time-based and time-weighted. So let's say that cable bill from Atlanta was turned into collection like 5 years ago. It is not that heavily weighted now because it's 5 years that passed. But as soon as you pay it and they mark it paid, it gets stamped with a date of 2022. And all of a sudden, even though it's paid, it's still a collection. And now it's weighted based upon happening in the last 12 months. And unfortunately, the most horrible thing is going to happen. Your scores will go down even further, which seems counterintuitive, but that's what will happen.
Okay. Wow. All right. Let's move on to the next prerequisite, income and employment. A big question that we get, believe it or not, from a lot of techies in the Bay Area who have been very fortunate and no longer have to work is, can you get a loan if you're not employed?
Absolutely. So there's two main profiles of individuals that we see this from often. One is the type of person you just described, someone that's made an enormous amount of money in tech or someplace else and isn't working, and they're probably not too old. The other one would be somebody of retirement age who has done well over the years and isn't working anymore. has maybe a very modest Social Security stipend, but has, millions or quite a bit of retirement assets in the bank. Both of these individuals can easily get a loan, and it's asset-based income for the techie who is not a retirement age. It's going to be through a private mortgage institution, kind of like a Wall Street firm that sees the common sense of basically being willing to lend to an individual based upon the margins of their assets. And they'll qualify purely off their assets for them. Versus the retirement age person, there's a lot of government programs out there that, Freddie Mac has programs, and most regular banks programs, regular 30-year fixed programs will allow for like IRA distributions and other kind of stipends taken out of retirement assets to qualify. I use on the latter, on the for retirement age people, I do a lot of asset-based lending for them just because it's very easy to do.
Okay, so let's talk about self-employed. What are the requirements in the case you are self-employed?
Yeah. So self-employed people kind of always cringe a little bit when I start asking for documentation because they do get asked for more stuff. So like if you work for a company, we're just going to ask you for pay stubs and W-2s. That's pretty much it. It's pretty simple stuff. But for self-employed borrowers, it's a lot more stuff. We're typically looking at all their tax returns, whether it's their personal tax returns or if they have an entity like an LLC or a corporation, the tax returns for that entity as well. The golden rule would be 2 years of tax returns, and then you would use an average of their income over the last 2 years because typically self-employed borrowers' income would fluctuate. A good example is a real estate agent. Real estate agents are going to have commissions and have years where they made this much, other years where they made that much. So the philosophy in underwriting is to use a 2-year average. But we do have some programs that will allow for as little as 1 year tax return if we want it, if it benefits our client. Like let's say that 2021 was much better than 2020, and we just want to use the income from the last year. We also have programs where we can use 1 year's tax return as well. And last but not least, a lot of self-employed borrowers now, where they've kind of shot themselves in the foot a little bit because they came up with lots and lots of expenses and they wrote up tons of stuff on their tax return to kind of be like the all-American way of like trying to dodge any income taxes and show very little paper income on their tax returns. Those individuals are going to have a hard time qualifying off their tax returns because they have, dodged a lot of their income by offsetting it with an enormous amount of expenses. So for those clients, there's a particular program called a bank statement program where the underwriter will look at 12 months of their business bank statements and will add up all the deposits. And the deposits on the bank statements will become their de facto income. And for somebody that is self-employed and isn't represented well by their tax returns, the bank statement program is a much easier way for them to qualify for a mortgage.
All right, so want to go back to the employment scenario in the case someone is employed. For example, if they have just recently started at a new startup and a lot of their income as opposed to base is on bonuses or stocks, RSUs, how do those play into the income verification and qualification?
Sure. So one of the reasons I like working in the Bay Area in California is that it's definitely not boring. It's not like a company town where everyone works at the Ford factory and just makes like their W-2 wages. And what's very important to understand is that the way that the tech companies have chosen to compensate their employees is within the tech industry, it's completely different as well. So for instance, the way that Amazon does it is completely different than how a Google or Apple does it. So, but in general, you would use the salary to qualify plus a 2-year average of any additional income, whether it be traditional cash bonus or RSUs. We have other programs where you only need to have 1 year of receiving the stock RSUs. Bonuses, as far as traditional cash bonuses, is pretty much always 2 years.
2 years.
And it's really important for your clients to understand that, whereas if somebody was like a school teacher and just qualifying off their income, and you sent them to me, maybe Wells Fargo, maybe Rocket, maybe 2 other banks, if it's just regular W-2 income school teacher, we're all going to come to the same conclusion. We're all going to pre-approve them for pretty much the exact same thing, because it's very standardized. But what we're talking about now, stocks, RSUs, this is the wild, wild west.
Okay.
Nobody does it the same. They could go knock on one door at a bank and ask about using RSUs, and the bank would say, no, we don't use those. Like, they're going to get no's, they're going to get maybe. The nice thing about us is we have a variety of programs that allow for the RSUs. We have a specific one for Amazon because it is such a unique unicorn of how they do it. Plus, we have probably 3 or 4 ways of doing the RSU income for any other tech company as well. And typically, we're able to use like 100% of the income to help somebody qualify for the maximum when they do want to use their supplemental income from Apple or Google or what have you.
All right, let's talk about debt to income ratio, otherwise known as DTI. So first, can you help to simplify or clarify what constitutes debt versus income?
Absolutely. In the denominator goes your gross household income, not the number at the bottom of your pay stub, but the number at the top of your pay stub. And once again, if you have income above and beyond your salary, a 2-year average of that as well, to come up with a gross household income for everyone that's going to be on the loan, whether it be yourself or you and your spouse for you. That's the denominator. In the numerator goes the proposed housing payment, which would be the mortgage, property taxes, insurance as a monthly stipend, plus any other debt that you may have. Maybe you have a $500 car payment. Lot that in as well. And that is your ratio, the proposed and existing expenses divided by your gross household income. And now I'm going to revert back to my multiple answers depending on jumbo versus confirming. If we're talking about sub 1 million and we're doing like FHA or Fannie and Freddie, you can sometimes maximize out to like 50% debt to income ratio. You can really push that to some really high numbers using half of your income to qualify. Versus jumbo, it is pretty much a strict 43% ratio.
Let's now lastly talk about assets. What do you evaluate assets for? Is it for the closing costs, for the down payment?
So when I'm speaking to a client, I will explain to them that as we get further along and get them pre-approved and underwriting, there's 2 hurdles that you have to meet for assets. The first bucket, the first hurdle is show us where the money's coming for the down payment. Pretty obvious, right? The second hurdle you have to meet is what I call the rainy day money test, or the technical term in our industry is reserves. And I'm going to give you different answers once again for different price points. In the sub million, sometimes you don't need any reserves. Sometimes you'll need up to 6 months of housing payments in reserves. Versus in jumbo, you would typically need a minimum of 12 monthly housing payments in reserves. Reserves can easily be met with retirement funds, stuff no one's asking you to touch it. You just demonstrate that you have it, and that's the test. The money doesn't have to be moved. It doesn't have to be liquidated. And for our company, Guaranteed Rate, we have some pretty easygoing reserve requirements, whereas there are going to be other companies like a Wells or First Republic where they'll want you to liquidate. They will make you touch it. They will make you liquidate it and make it into cash. They have a far more onerous reserve requirement.
Okay. And can you help clarify what goes into that monthly payment?
Let's say that your mortgage payment is like $3,000, right? And let's say that your stipend for insurance and interior insurance and property taxes is another $800. And let's say that it's a condo and your HOA dues are $500. If you add all those together, your monthly payment is $4,300. Okay. So let's say you're getting a jumbo loan. So you just take the $4,300 times 12. That's $51,000 plus change that you would need to show in like a retirement account or something to show that you have rainy day money. And if you were to run into a hardship down the road and you needed to have access to funds for an emergency, or you're unemployed for a stint, that you have something you can tap into.
Okay. So to clarify, you don't care about any ongoing debts outside of the mortgage itself.
Just a housing payment, correct?
Okay.
Somebody has a bunch of student loans. They just got out of school recently, and they have, thousands of dollars of payment in student loans. Those go into qualifying on the debt to income ratio, but they do not go into the reserve requirement.
Great clarification. Okay. And final wrap-up question. Does all of this also directly apply for the case of refinancing?
Yes, except for the assets are really not super important on a refi. You already bought the place, you're already in there, so assets are not really looked at very much.
Okay.
Maybe on my typical refi files, I may ask them for like one retirement account or something, but we're not asking for tons of bank statements and we're not scrutinizing assets because we're not looking for money to come into the transaction.
Makes sense. All right. Thank you so much, Stephen, for all of your rich answers and knowledge. And I hope that we will have more sessions like this, because that I have a lot of questions for you. But I'm sure our audience will really benefit from this, and we'll be happy to have met you in person.
Great. I look forward to it. I'm glad that the dog did not bark during the last period, so we're lucky.
Yes, we did well. Okay. Well, thank you so much, Stephen. I really appreciate your time.